as the market headlines are dominated by the continued rally from Friday's lows. There's something that triggered last week in the markets that we definitely need to talk about, and that is the Hindenburg Omen. And as you can imagine, the Hindenburg Omen has actually been as bad for the markets as it sounds. In this week's video, we'll talk about what the Hindenburg Omen is, the last couple of times it triggered and how the market performed, and lastly, we'll discuss why this time might be a little different. Before I get into the Hindenburg Omen, I just wanted to recap last week's volatile trading week. The market opened up sharply on Monday, but then proceeded to sell off, and actually the S&P 500 was down almost 5% from the highs on Monday, before a sharp rally to close out the week happened on Friday. And the S&P 500 actually was up almost 1% for the week. The Dow was up almost 2%. The NASDAQ was down 2% and has been the lagger for the year. And foreign led emerging for the week, but emerging still has been outperforming year to date and is up over 4%. So now let's talk about the Hindenburg Omen. And the Hindenburg Omen triggers when there are more companies making 52-week lows versus making 52-week highs, while the market is positive and continuing to push higher. And that's exactly what we saw last week. Now this is a market breadth reading to really look under the surface of the market. And although we continue to push higher for the year, there are signs of weakness as so many companies are starting to make 52-week lows. So now I wanted to look at the two most recent times that the Hindenburg Omen has triggered. The first was September of 2018. And if you can remember back, the market actually saw a 20% correction from October to end of the year. And then the most recent Hindenburg Omen triggered in November of 2019. The market proceeded to push higher all the way to February, only to have a 40% correction in the month of March. So this isn't something that happens overnight. And it's really just an indicator to show us that there is weakness under the surface and we could see some volatility in the markets ahead. Now we have two key reasons that could lead to this time being different. And that is, the market has already pulled back and bounced quite significantly off of a key support level. And the next thing is we have the new coronavirus stimulus bill that is $1.9 trillion of money that will eventually find its way into the markets. Now we're going to be watching two things very closely for the weeks ahead. The first is what's going to happen with interest rates, as Jerome Powell has already stated that he's going to implement a plan to control the yield curve. And the second thing is we're going to be watching a key support level throughout all of the indexes to make sure that level holds. Thanks for watching, and if you found us on YouTube, make sure you subscribe to our channel and also follow us on Facebook. See you next week.